Good afternoon, and thank you all for joining our next installment of the NYSCA Presents webinar series. I'm Abigail Young, Deputy Director of Operations and General Counsel at NYSCA. I'm pleased to share with you that we have attendees from all 10 regions of our state with us today. Some of you may have attended our PPP and SFOG webinar that we held back in January, and we felt it was necessary to hold another webinar to respond to recent developments and provide our field with the latest information about the PPP process and claiming ERTC, the Employee Retention Tax Credit. I am thrilled to be joined today by Andrew Marietta, VP of Regional Development at NYCON, the New York Council of Nonprofits, and David M. Rottkamp, CPA, partner and not-for-profit practice leader at GRASSI, and NYCON board member. We are so grateful for their expertise and for taking the time to develop this webinar so quickly with us. NYCON is one of NYSCA's most valued partners, providing unparalleled technical assistance, trainings, and educational resources for nonprofits across the state. A reminder that NYSCA grantees qualify for technical assistance from NYCON, which includes support in applying for and reporting on PPP, SFOG, EIL, and claiming the ERTC. A quick reminder to all in attendance that NYSCA announced our FY 2022 opportunities in mid-June, and you can access all related information, including guidelines, the application manual, and informational webinars on the NYSCA website. A reminder also that the deadline for our first opportunity, the Restart New York Rapid Live Performance Grants, is tomorrow, July 1st at 4 p.m. We are grateful for Governor Cuomo and the legislature's historic funding and recognition of the critical role arts play in the state, in the health of our state. Thank you to everyone who submitted questions in advance for the webinar. Please know that we will be having a dedicated time in the session for Q&A, and we encourage you to listen to the entire presentation before submitting any questions through the Q&A feature below on your screen. We're going to be recording the entire session and posting along with the slides on the NYSCA Presents page on our website following the session. So without further ado, it is my great pleasure to welcome Andrew to the NYSCA Zoom stage.
Great, thank you, Abigail. Just going to pull up our presentation for our discussion, and thank you again to everyone for joining us for this important discussion. And we will be jumping right in to how you can really take advantage of this opportunity related to the Employee Retention Tax Credit for your arts organization, and hopefully we can answer some of those pressing questions on how your organization can really explore this and make the most of it and take advantage of this this credit. I'm very pleased to have David Rockkamp joining us today, long-standing NYCON board member and an expert in his own right as a CPA. And I just wanted to have David just say a couple words, especially in terms of really bringing the experience of on the ground and what's that's really the role he'll be playing today, and especially in terms of the Employee Retention Tax Credit and really what's going on out there with the sector. So David, feel free to give us a little context about who you are.
Great, thank you, Andrew. I appreciate that, and thank you everyone for joining us. As a almost 35-year member of the nonprofit community, serving as a CPA in public accounting, working with hundreds and hundreds and hundreds of nonprofit organizations over 3+ decades. The last 16 months has probably been some of the most challenging times that all of you have faced. Luckily, the federal government has produced an alphabet soup of relief plans that are eligible to nonprofit and commercial organizations that are considered arts organizations. Today's discussion will focus on the ERTC, the Employee Retention Tax Credit. But keep in mind, this is and dovetails with the various other funding relief programs that are out there, whether it's the Paycheck Protection Program, the PPP, the SVOG, the Shuttered Venue Operators Grant, the Economic Injury Disaster Loans, the EIDL loans, and advances that were received there. Many organizations, many of our clients and many of our newer clients in the last 12 to 15 months have looked to us for advice and counsel to how to navigate the challenges of calculations, the challenges of reporting, and how the interplay works among all these various programs. So whether you're working with us, you're working with NYCON through NYSCA, or you're working with your own financial advisor or accountant, I suggest you continue to have that dialogue with those folks to help you walk through the maze of activity. And it is a nice maze to have. It's unfortunate we have to be in this path to have received this, but it is available to most of you, presuming there's eligibility requirements that are met, which we will talk about. And we're excited to jump right in for the next 51, 52 minutes and walk you through the ERTC. Andrew.
Great, thanks, David. Yeah, and you'll definitely hear us stressing that reminder that bringing qualified financial expertise in terms of your CPA firm or whoever might be the resource available to your organization is definitely a recommendation and helpful as you maneuver through trying to better understand how to take advantage of the employee retention tax credit and these other resources that again, good problems to have, unfortunate circumstances that brought them about. But what we're here to discuss is the ERTC and really try to give you a good handle on what this credit entails, and then how you can move forward today. And essentially you can take advantage of this credit, and hopefully we'll give you that understanding of how you can take those next steps. So just in terms of the baseline definition, this is a refundable payroll tax credit that is taken against your employment taxes that you're paying, those payroll taxes that you're submitting. And so we'll talk about it. All of this comes down to this quarterly determination and the quarterly payroll taxes that you're paying. So that's a lot of our focus for our discussion. But in terms of the actual credit, it is a refund on those employment taxes, and David will actually give us a little more context when we talk about claiming the credit, and also how that refund actually might look, either as a rollover or an actual refund. So we're going to have David weigh in on that. Just to give you a little context of kind of the evolution of the employee retention tax credit, we did see this introduced, and again, we've had these various stimulus legislation developments over the course of 2020 and 2021. Already feels like maybe a decade instead of a year and a half. But we were first introduced to the employee retention tax credit when it became available through the CARES Act. It was available through the end of 2020. And we're going to talk about the distinction between the eligibility and the actual tax credit, how you qualify for it, and the actual tax credit amount for 2020 versus 2021, because there is absolutely a distinction. I won't necessarily just get into the details right here, but just more so you kind of see CARES Act. That's when we first had the opportunity for this the ERTC and the opportunity to take advantage of it, but not necessarily if you had a PPP loan. So we'll talk about how that was repealed, and now here we are being able to look at 2020 and 2021. And then there was this modification with the Taxpayer Certainty and Disaster Relief Act at the end of 2020. That's where we also saw a number of changes with PPP. Actually a decrease in the reduction qualification that applies in 2020 or 2021, and that's really where I think many organizations have the most opportunity and will see the most benefit in terms of this credit. And then, of course, with the American Rescue Plan Act more recently, it extended this credit throughout all of 2021. So you now have all 4 quarters to take advantage of it. And so that's really, a lot of what we're going to be talking about here is that distinction of 2020 versus 2021. And just to kind of start with some general information. So in 2020, that credit actually would be applicable to wages that started March 12, 2020. So that, that when the actual CARES Act comes into effect, the impact of the pandemic. And so you have that applicability throughout all of 2020. And then we have this eligibility, the way we qualify for it, and you're going to see the same similar information for 2021 when it comes to these 2 options. Either fully or partially suspension of your organization operations that came about through a COVID-19 governmental order. So that's the same in 2020 as it is in 2021. And I did include a definition here of governmental order. We're going to talk a little more about that full or partial suspension, and that if that is a consideration you're looking at, how to qualify for the credit. There's some more information we'd like to just relate and kind of encourage people to to really think through if you're going to take that option. Or the second eligibility opportunity is the gross receipts decline. So in 2020, it would be by 50%. And we make that calculation, as we'll see, by comparing first quarter 2020 to first quarter 2019. And then in 2021, we have a lower threshold of 20%. And now we're comparing first quarter 2021 to first quarter 2019. So each quarter you're looking at that credit, we're making that comparable comparison. So depending on the year, second quarter 2021 to second quarter 2019, that's how we're going to make that distinction of that gross receipts decline. So David, anything you wanted to add before we move to the shutdown piece?
I would add, Andrew, that whichever method you're able to qualify under for eligibility is documenting the calculations and documenting a determination around partial or full shutdown is going to be vital. While there is no specific reporting requirements outside of amending a quarterly 941 for purposes of the refund or the tax credit application, you are obligated under IRS rules and Treasury rules to maintain documentation. I believe it's up to 6 years, which you might be subject. It's either 3 or 6 years. I'm sure Andrew has that specifically. I know PPP is 6 years. Typically IRS is 3 years, but this might be a 6 because of the relief programs, that you have to have documentation to support the positions that you're taking and the calculations that you're making.
Yeah, I think I actually am not exactly sure what the document retention requirements are. I know for PPP it would be, I think it's 4 years for the overall application materials and 5 years for the payroll documentation. So it's, we were just actually having this conversation separately from this discussion, David, with some of my coworkers. And I think ultimately the commitment here is exactly to what you're saying. Make sure your documentation is order and plan to keep that documentation probably for at least 6 years, I would say.
Yeah, it's typically federal government contracting requires a 6-year window for holding on to materials from a document retention perspective. So even though it might be 3, 4, or 5 years, I would say hold on to it as long as you can, and then follow your policy for destruction when it's time for that to happen for both paper and electronic and remove. But keep track of what you're doing and keep track of it contemporaneously. You want to do it now, not something you want to be looking back 3 or 4 years from now and having to recreate.
Right, and it's interesting for organizations that have filed or are filing for the PPP loan forgiveness, and probably the majority of organizations that are joining us right now probably have been able to take advantage of the 3508S or the 3508EZ. And in the cases of the 3508S, you actually don't have to provide that documentation, and so that's kind of been a question that's come up on ERTC. When we're filing for it, what kind of documentation do we have to provide? Well, you actually have to have your documentation in order. You're keeping that documentation on file, and I guess, David, it wouldn't be out of the question maybe sometime in the future. Who knows what the federal government might do, but they could request that documentation, I suppose. But you really need, it's upon you. It's your responsibility to have that in place and have that clearly outlined. So if you were asked to submit it, you would be ready to do so.
Without question.
Is there a checklist or an easy to access document for what types of documentation you should be saving for the different kinds of programs?
I mean, PPP is pretty clear. PPP has been very clear about, what documentation you need and really need to hold on to. I mean, I think with ERTC, as we move through this discussion, I think, on the ERTC, it would be pretty clear. For example, I mean, it's going to be payroll, health insurance information, and the gross receipts piece.
Right, the gross receipts or the partial shutdown. So it's going to be the two components of eligibility plus the actual calculation of the eligible wages that you're reporting on 941 and the credit calculation. Those would be the key things you'd have to maintain, including the supporting documentation, which, because this is a quarterly calculation, almost every payroll company has quarterly payroll records that support the quarterly 941. So you're not gathering, 12 weeks of payroll data or 6 payroll registers. You should have a quarterly report, which should give you everything minus the wages that are not allowable under the ERTC, which we'll get to now.
Yeah, and so this documentation will be a common theme here, I think. But so on the business operations suspension, this is an area where, again, kind of going back to David's earlier point about it is helpful if you do have the access to your CPA firm that might be helping if you're subject to qualified financial review at 250,000 and above, or a full audit. Your firm would absolutely be a great resource to discuss if you're pursuing the business operations suspension. What you're really looking at here is that defining of the impact of that governmental order as a result of COVID-19 on the substantiating that the impact was more than a nominal portion of your business operations. So it's, I guess the main takeaway I look at, David, is that you can't just say, yeah, we were impacted by a business operations suspension. There's a little bit of looking, at the actual income, the gross receipts reduction impact, and so they have this, not less than 10% of your total gross receipts as you're looking at that portion of business that was impacted. So for nonprofits, it really would be your overall business operation you'd be looking at, and I assume you'd be really trying to make the case that 10% was your threshold, that you were impacted from that perspective, and that the 10% total gross receipts, that order resulted in that decrease. Is that fair?
That's a fair statement, Andrew. What I would say is that 10% is a number that's put out there as more than nominal or more than insignificant, I guess, another way of looking at it, where the PPP has certain safe harbors that you could qualify under for filling out a 3508EZ form, which also talked about not operating at the same business level activity during your covered period as compared to 21520. This is a different definition than what the PPP is. So just keep that in mind. If you did have a PPP loan in 20 and you're looking for an ERTC maybe in 21 or even in 20, while there might be similar concepts, you want to understand that they are slightly different in terms of approach. And here the 10% and more than nominal is a key piece of that. Looking at the revenue generation for the quarter that you're determining eligibility, let's say it's a Q1 21, you're looking at this 10% calculation in 21. And again, you may be looking at the same quarter in 2019, which is a baseline quarter. Now, for many of you, it may just be one business operation, one business unit. So looking at revenue reduction might be very simple and straightforward. For other organizations that might run multiple programs, and certain programs, maybe the live portion programming of your activity is what was canceled or unable to operate, but maybe there's an educational side of what you do as well, and that was able to continue on a virtual basis. So you want to look at the impact of where the partial order or partial shutdown or a full shutdown takes place within your business operations. Again, if it's just one general operation, it's relatively straightforward. Just look at total revenues from a gross receipts calculation, which I'll go through the definition in a couple slides. If it's multiple programs, look at the one that's impacted. And if it's impacted on a total basis in multiple programs, then that's fine as well. But just again, show the position, take the calculation, and document what you're doing.
And so I guess the main point here is that this business operation suspension maybe on the surface might look to be very straightforward, maybe a simple option, but you may have it may be a better option to really look at the gross receipts decline options, because they're much easier to calculate. So you're really first we're going to look at 2020, then we'll look at 2021. But this is the other, that kind of there's one option, and then this is a second option. I think this is the one that most organizations seem to grasp more easily. That we're looking at Q1 of 2019, and we're going to look at Q1 of 2020, and we're going to actually take the overall gross receipts and make that comparison and see what the decline was. And then in the case of, again, making that distinction between 2020 2020 versus 2021, you have a higher threshold for that gross receipts reduction for 2020. So we're looking for a 50% reduction minimum. So in this scenario we're outlining here, you'll see, so first quarter pandemic really hadn't fully been realized. So it's really second quarter where this hypothetical organization is seeing a reduction. And so that threshold of 40% is both, well within the actual 50% qualifying range. So they actually now are able to take advantage of the employee retention tax credit in that second quarter. But then as you follow, their overall gross receipts reduction was greater than 80% in the third quarter. So they are now basically, I don't know if disqualified is the right word, but they're not eligible as they look to basically that quarter. But the look back provision as a part of the credit allows them to actually carry into the third quarter. And I'll let David comment, if there's a better way of describing that, but basically they're going to get second and third quarter, even though they get bumped out of eligibility because they're above 80% for the overall, when they go back and look at the gross receipts calculation for third quarter. So David, did you want to add?
I would add, Andrew, maybe we can jump ahead to the next slide, which is a 21 calculation, because I think that's where most folks, most folks are going to fall into 2021 versus 2020, only because the tax credit is much more advantageous in calendar year 2021. In 2020, it's capped at $5,000 maximum for the entire time period of the year, regardless of assuming you have a quarter of eligibility. Whereas in 2021, the eligibility, each quarter stands on their own, and you have the opportunity for a much more significant tax credit by quarter. The credit's up to $7,000 per employee if you qualified per quarter of eligibility. So to Andrew's point, if you qualify because you have you hit the gross receipts reduction test, that you have less than 8% or more than 20% decline, say in quarter one, which is happening with many organizations, January to March. In this example, it's 75%. Once you do the calculation for ERTC, then that closes down the first quarter. Then you go to the second quarter, and you start all over again. So whether you're looking at the partial shutdown or the revenue reduction, it's on a quarter by quarter basis. So here in the second quarter, you can see by the example, they're down to 76% of the 2019 year, which is still a 20% reduction. More than 20% or so they qualify in quarter two. However, in quarter three, they don't qualify under the 20% threshold calculation because they're back at 84%. But to Andrew's point, even though you don't qualify under the threshold of more than 20%, there's a look back provision which allows an organization to say, did I qualify in the previous quarter under partial shutdown or gross receipts testing? And in this example, they did. In the second quarter, they qualified under the gross receipts test. So because they qualified in Q2, even though they didn't qualify in Q3, the look back provision allows them to automatically qualify in Q3. So they would, in this example, they would be applying for a tax credit in Q1, then Q2, and still in Q3, even though they're at 84%. And you have to document all that within your internal materials. Let's say in the fourth quarter, which you don't know because the fourth quarter isn't closed yet, you don't have the information, but let's say that number in the fourth quarter, October, was still at 84%. Well, unfortunately, because the previous quarter didn't qualify at the threshold, you wouldn't qualify in the fourth quarter. But if that number drops to 79 or below, then you're going to qualify in Q4 again. So each quarter stands on their own, and you get the opportunity to look back one quarter for qualification, whereas if you don't qualify under the existing two rules.
A quick clarification, gross receipts, is there anything that's excluded from that, or contributions, other stimulus included?
There will be, and that's the next slide. So the gross receipts calculation, Andrew, I'll jump into this and just talk about the 6033 regs. I'll let you talk about the other stimulus plans. But the Department of Treasury and the IRS defines gross receipts for a nonprofit organization under 6033, section 6033, which has 5 elements or 5 buckets that you have to follow as part of your calculation. It's not just taking your accrued-based revenue on your financials or your tax returns. It primarily is taking your GAAP financial statement of revenue, but it does take into account a couple things. You cannot have any expenses that reduce gross receipts or gross revenue. So if you have special events with direct costs or other types of cost of sales, you have to get rid of those, add them back into the calculation for gross receipts, as well as if you have investment activities. This is very important. Unrealized gains and realized gains are not part of gross receipts, but what is part of gross receipts is the sale of investment vehicles in that quarter. So if you have a realized gain of $10,000, that $10,000 gain, which you record on the GAAP accounting, is revenue, but that revenue is driven by a $100,000 sale of investment from proceeds, and they had a cost value of $90,000, so it had a gain of 10. You had to back out the 10 and add in the $100,000. So that is a significant piece that you want to think about, and it's all assets. It's sale of buildings, sale of real estate, sale of investments, and things like that. So those are the two key things. It includes contributions, gifts, grants, fundraising amounts, program service revenue, ticket sales, all those fun things you would normally include as part of gross receipts. Now, Andrew, there's been questions around what happens if you have PPP money that's forgiven, showed venue grant money that, although it's not going to happen yet, that's going to be forgiven, but what happens with these stimulus program revenues when they are forgiven and earned as revenue?
Right. We've had that question come up, and so that was the main reason, to David's point, we wanted to make that clarification. Some organizations have drawn the conclusion that their PPP is treated as a part of gross receipts, and we just wanted to make that clarification. That is not the case. So the PPP is actually, the PPP itself is a liability until you actually secure loan forgiveness. Once you secure that loan forgiveness, it actually is excluded from the gross receipts calculation. So it will not impact your gross receipts decline. So you don't have to worry about that PPP funding in terms of when you recognize it, or when that loan forgiveness is secured in whatever quarter that occurs for your organization. So that's one less thing you have to worry about, as well as the idle advances if you were able to receive those economic injury disaster loan advances or targeted advances or supplemental targeted advances that they added, the series of advances. Yeah, to David's point, and this actually came up, David, I received this question recently about fiscal sponsorship. An organization's a fiscal sponsor for another organization, they get a grant. They don't touch the grant. Do we have to count that as gross receipts? And the unfortunate answer is yes. It is your revenue. It's hitting your books, and I assume it's a programmatic grant that absolutely would be a part of your gross receipts. And unfortunately, that might impact their qualification for the economic injury, or not the EIDL, but for the employee retention tax credit. So the gross receipts piece is a good thing to get a handle on.
Good. Let me add one strategy here to folks, and another question that came in, which we can answer. We don't have a slide specifically on the 5 buckets, but if you go into any internet search tool and type in IRS, Department of Treasury section 6033, it's going to be, I think subparagraph II is going to give you the purposes in subparagraph 4 of the gross receipts calculation. You may, if you have the ability to manage contribution inflow into your organization, and that, because many of you are receiving restricted contributions to help sustain operations and businesses from other private funding sources. If you have the ability to potentially delay or defer contribution revenue because you're allowed to under accounting principles, you may want to think of trying to capture some of those in a different quarter. If it helps you by not having them in a quarter, get you to that less than 80% or greater than 20% threshold. So just think about that as you are looking at your quarterly revenue calculation as you go forward into Q3 and Q4, since we're on the last day of Q2. All right, Andrew, next slide.
So we just wanted to touch on the eligibility side. This is a point that has been create a little bit of confusion, that organizations sometimes think only full-time employees qualify in terms of the wages that you can claim for the employee retention tax credit. There is a factor in terms of your qualification or eligibility for ERC in terms of the number of full-time employees, as I touched on earlier. It was in an earlier slide, not necessarily highlighted, but 100 was a threshold for 2020 and 500 for 2021. So we had an increase, but that is not an FT number. That's actually an average employee number figured out by taking an average of 30 hours per week or 130 hours per month to figure out if your employee count, if you're under 100, you're safe for 2020. If you're under 500, you're fine for 2021. And I'm sure most organizations joining us today probably are under those thresholds. But in terms of once you figure out, okay, yeah, I have 50 staff, and so that puts you in the, definitely in the safe zone for 2020 and 2021. Any of those eligible wages paid in terms of part-time or full-time would be basically applicable to the employee retention tax credit, depending, of course, on the use of PPP funds. And we're going to talk about that interaction here in a moment. I know it's already a question on been submitted here, so we'll move on. Just what we wanted to just kind of give you is a quick chart that kind of brings a lot of this information together, so you can see here, again, the distinction of between 2020 and 2021. So the amount of credit, just reinforcing it's 50% of the qualified wages versus 70% of the qualified wages, and it's at first $10,000 per employee. So as David mentioned, 2020, it's a $5,000 maximum credit that you're going to get for an employee. That's the max. So it's going to be 50% of that $10,000 of qualified wages. For 2021, that's where the big opportunity is for organizations. A quarter by quarter, $7,000 per employee per quarter maximum. If you had the opportunity, you could possibly claim $28,000 per employee when you add up all 4 quarters. Again, just reiterating the employee size here issue, it's 100 employees for 2020 versus 500 for 2021, and it takes into account whether the employees are performing or not. This idea of not working. So if you're paying wages to employees who are not working, you're still getting to claim those wages as a part of the credit. And just continuing, the advance payment was an option. We might touch on that a little bit more. It's not really an option that David could speak more to this, that has really been to the advantage of employers. So most organizations probably are not going to take that option in terms of filing for the advance payment, because as David had mentioned in a previous discussion, the IRS is very delayed in processing the advance payment requests. And then we did just 2 other pieces here: the limitation on increase in pay rate and the PPP loan eligibility. This is where we had original rules in place as of 2020, and then we saw a repeal in terms of how they're treated. So originally in 2020, you had a 30-day look back period for determining those wages. They counted towards the credit. Then in 2021, they actually repealed that, so it could include raises, bonuses that could be counted towards the credit. And then same issue with PPP. You couldn't claim the Ertc in 2020. Now you can. That's been repealed, and so you now have this option of looking at 2020 and 2021. And so then this is where we wanted to just touch on the actual claiming the credit. I'm just going to cover very quickly the form side of it. David's going to give us a little more detail about the insight into how that form is laid out. But basically, again, making the distinction between 2020 and 2021. 2020, you're going to go back and essentially you're amending your quarterly payroll, your quarterly federal tax return with the IRS. So you're filing this form 941X because you're amending it. And so you're going back, once you've calculated that credit, what quarter you're claiming it, you're going to go back and file that. There is some issues here around PPP and the wages you can claim for the Ertc versus the use of the PPP. You cannot claim both for the same wages, and we're going to touch on that with another slide here in a moment. But so 2020, you're going back and amending. In 2021, you probably have more of an opportunity to actually figure out your tax credit and file it in real time. So,
Andrew, just to state the obvious, not too late to file for 2020, right?
Correct. Yes.
You should be doing. If you haven't done it yet, no penalty. You can look if you're still if you're
you can go
eligible,
back
you
and
can do it.
amend. Yep. You can file that form 941X and amend it 3 years, David says. So up to 3 years to figure that out. So with 2021, we finished first quarter. We're about to finish second quarter. So first quarter, you may have already filed. You're probably looking at amending, which would be form 941X, versus second quarter, as David had mentioned earlier. You have up to 30 days, correct, the next month
You
to
do.
file?
So the 941s are due 30 days after the close of the quarter. That's the next end of the following month. To Andrew's point, if you have filed your first quarter 941 already and you're eligible for the employee retention tax credit, you'll be filing what's called a 941X, which is an amendment to your 941. It's an adjustment to your quarterly tax return. And what you're doing here is you're indicating down in part 3 of the actual form on lines 18 and on lines 26, the non-refundable portion of the employee retention tax credit and the refundable portion of the employee retention tax credit. Keep in mind the non-refundable portion of the tax credit is 50% of the employer FICA wages that's being picked up as part of the 941 filing to begin with. So the 941X allows you to introduce the refundable and non-refundable portion of the credit into an amended return. You drop in the qualified wages and qualified health insurance expenses to show support in totality by 2 numbers to show what the tax credit is based off of, and it will flow its way down to the bottom to indicate that you have a refund opportunity for purposes of that particular quarter. When you do file an X, you have to provide a detailed explanation as to why you are making corrections. And for the most part, it's as simple as saying you have determined that based on the eligibility criteria, the XYZ organization is eligible to amend its first quarter 941 to claim these credits. And then you indicate during the quarter, you indicated X and Y amounts that were eligible to be claimed for the credit. More importantly, if you're in the second quarter and you're eligible, which is closing today, you have 30 days to file your actual 941 to meet your filing requirements. Our suggestion would be to try to do the calculation of the ERTC now in this quarter so you can introduce the calculations directly into your second quarter filing. That will be the fastest way to get it processed and get the refund back to you. The X will take some time. The Form 7200 advance payments are, while it's out there, are almost not even being processed at this point. They're so far behind in processing those. But on the 941 itself, when you fill out your normal activities in part 1 of the form, which you normally do, you would pick up on line 11C and on line 13D, again, the non-refundable and refundable portion of the employee retention credit from a particular worksheet number 1, which is included. And it allows you to then do the mathematics all the way down in that section to show either an amount due for the quarter or an overpayment. And like you do with the unrelated business income tax or 990T, the overpayment can either be applied to the next return, or you can ask for them to send a refund. I'm of the opinion you always want money back from the government in your pocket. You don't want to apply. You can apply it next time if it's a UBIT issue, but if it's a credit like this, I would say take the money and run, as they say. Put it in your pocket and move forward with your business. So you would want to check the send a refund box within there as well. And lastly, you have to indicate in part 3 of the current 941, which is a new part, what is the qualified wages for the employee retention credit and what's the qualified health plan expenses allocable to wages for the employee retention credit as well. And sign, seal, and send off through your process. Now, keep in mind, if you have a standard payroll company, they can introduce these numbers into the form. After you give it to them, you should review them to make sure it's right, or give it to your financial CPA advisor to help you with that calculation. If you're in a PEO situation, it's a little more complicated because the PEO is doing a payroll quarterly filing on a bulk basis. So you have to speak to your PEO company about how they're going to process the 941 for your piece of the credit you're looking for.
And David, we had discussed this earlier, but that health insurance piece is something that actually doesn't show from a wages standpoint in terms of that Form 941. It's not something that would show up in the filing, but now as a result of the employee retention tax credit, they actually are asking you specifically what that qualifying health insurance wage or expense information is. So it's like similar to the PPP. They'd keep the documentation of the billing for the health insurance on file, but they would end up inputting those numbers into the form, like you had mentioned.
That's correct. Keep in mind that payroll comes from your payroll register, your quarterly payroll register. So anyone who is under $10,000 of payroll for the quarter, eligible payroll for the quarter, taking out some of the exclusions that are built into the ERTC wage definition, then you have the ability to add on top of the wages the amount of healthcare, allocable healthcare insurance for that particular employee that's paid by the employer. You add that up, as usually in a separate Excel worksheet is my suggestion for all that. You have the wages, then you have the employee benefits, paid group health insurance, then you come to a total. Your max is $10,000, which then gives you a credit of $7,000. If you only have a max of $9,000 based on wages and applicable health insurance, then your credit's only $6,300 for the quarter. And the calculation starts all over again the following quarter based on eligibility.
So
we have a lot of questions. Andrew, so let's go through a couple more slides and then we'll get through some of the questions that we have.
Absolutely. So I think the last piece is just wrapping up. We wanted just to make sure everyone understands that interplay between your PPP and your ERTC. So really the main issue here is that you can't, if you're depending on how you allocate your PPP towards wages, you can't actually claim those same wages then for the employee retention tax credit. So the problem here with 2020 is that most organizations fully applied their PPP probably to 100% wages. So in a way, we're going to kind of skip to the next one because, again, as David mentioned, 2021 is really where the opportunities are for organizations. You can better manage and maximize not only the use of your PPP, but also maximize the tax credit, the employee retention tax credit, and that you go about doing that really by maximizing non-payroll eligible costs with PPP, which you can maximize up to 40%. We have a number of new categories that were added for those non-payroll eligible expenses. So the idea here being is that the absolute minimum threshold you have to meet is 60% of your PPP use on wages. So as long as you meet that minimum threshold and maximize the non-payroll costs, you could free up additional wages that you now can claim through the employee retention tax credit. And that's the concept here, to really better manage how you're applying those PPP funds, take advantage of other qualifying expenses outside of payroll that you now can use to claim for the employee retention tax credit.
I would just add to that, if you received a PPP-1 in 2020, you're not applying for ERTC, no concern. If you apply for a PPP second draw loan in 2021, and you then also have the eligibility for the ERTC, you want to look strategically at the payroll and non-payroll amounts for PPP first to ensure you have enough salaries to be able to claim the employee retention tax credit. The key thing here is you can't double dip. But once you use, let's specifically, an eligible weekly salary for PPP is $1,923, which is the $100,000 annualized by week. So if someone is making anything more than $1,923, you can claim $1,923 on PPP. Let's say they were making $2,500 a week in payroll. The additional $600 and some odd dollars could go towards ERTC. And then you'd add the health insurance for each week, adding up to the quarter. However, if you had the ability to manage the 60-40 split, and maybe you only needed $800 for PPP to manage the 60-40 split for PPP, you may open yourselves up to, I said $800, $1,700 for maybe ERTC salaries per week. So when you multiply that times 4 weeks over the course of a month, you can see how the numbers could inflate on the ERTC and to get you to that closer to $10,000 max. You can't double dip, but you can take someone's salary and bifurcate it between PPP eligibility and ERTC. And this is vitally important if you have both programs running in 21 or during any quarter of potential ERTC. You have to maintain an Excel schedule. The only way I can see doing it, that's going to be clear documentation, taking someone's salary, earmarking it next column to PPP and next column to ERTC. Add up the ERTCs, and that's how you form an audit trail for any potential scrutiny down the line. But these are some of the strategies that your financial advisor, your CPA should be able to help you with, or someone at NYCON or others who can provide you some guidance and assistance there.
Yeah, and to David's point, you know, we just had this simple example at the bottom here. If you had a PPP second draw and it hit in terms of covered period in May 1st and it ended July 31st, depending on how you're applying that, you may have some opportunity to claim some of those wages in quarter 2 and quarter 3 when the PPP is playing out during the covered period. Quarter 1 may be totally open, quarter 4 may be totally open, but all of this is going to come down to, are you eligible in terms of that gross receipts reduction, or if you're pursuing the partial or full shutdown option. But one way or another, kind of to make these calculations and do your due diligence. And of course, to David's point, document everything so you have it, for your.
Andrew, let me ask you a question here because it's, I think, very relevant to the point we just looked at. If you have an NEA regrant, should salaries paid by that be deducted from your eligible salaries for either PPP or ERTC?
So the one thing we definitely have clarification on is that the NEA ARP grants that through NYSCA's assistance, we've been able to clarify that organizations absolutely can apply for those NEA new additional grant opportunities, even if they are taking advantage of these other federal funding pandemic resources. But the one positive to say for the NEA funding is that funding actually doesn't hit, or you actually don't receive it until January 1st, 2022. So the employee retention tax credit actually will sunset in 2021. So that's one piece of it. In terms of the NEA itself, and a grant you may have right now, in terms of programming or operation support, it shouldn't impact your employee retention tax credit claim as far as the qualified advice we have and guidance from the IRS at this point. You absolutely should be able to claim the employee retention tax credit, even if you have an NEA grant, for example, providing some kind of operating support to your organization. So from that standpoint, our understanding, there hasn't been any other guidance given. You should be able to move forward with the credit.
Okay, let me get to the financial reporting slide, Andrew. Take a look at some of the open questions that are out there right now, and we'll do some power responses over the last 10 minutes of our session today. With regard to the reporting of the ERTC, there has been absolutely zero guidance put forth by the FASB, which is the Accounting Standards Setting Board, nor the AICPA, which helps CPAs address auditing needs as well as accounting application as well. In hearing folks from the FASB speak and various conferences that I'm either participating in or where I'm speaking or co-presenting with folks from FASB, there is some things that we can think about with regard to how to report. This is for 21, it's a quarterly calculation, so each quarter stands on their own. The eligibility requirements, the calculation, and the forms of filing stand on its own. Therefore, the reporting into the financial statements will stand on their own as well by quarter. If you are eligible and you have a calculatable tax credit, which is going to be claimed through a 941X, 941, or the 7200 refundable advance process, you have a earned revenue recognition process that you're able to utilize to record financial revenue in that quarter. Think of the ERTC as a government contribution, a non-reciprocal transfer of assets. It doesn't have any restrictions, doesn't have any conditions, doesn't have any barriers. So once you are entitled to the contribution amount and you're able to calculate what that contribution amount is, our recommendation, again, speak to your CPA professional who you might be working with for further guidance, and I'll tell you where to go for that in just a moment. We believe you have the ability to record a receivable and revenue equal to the amount of the total credit you're applying for in the 941. To me, the revenue categorization is either a government grant or a contribution without donor restrictions for the reasons I just set forth. And the one question that is out there that remains unanswered, although we have an opinion from someone at FASB, but it's not a FASB opinion, it's his own personal opinion, is whether when you record the credit as revenue, you should reduce the expenses, the FICA tax expense, the employee portion of the FICA tax expense, the employer portion of the FICA tax expense, as a reduction to bring it down to zero for the quarter and record the revenue as net. His opinion was not, and I would concur with that. Typically, when you record a contribution that might have some relation to other expenses, you would not net down the expenses. You would record the expenses in the period it's recorded and record the contribution revenue, or in this case, potentially government grant without restrictions, in its totality in your financial statements. But again, if you are being audited or reviewed or compiled through a CPA firm, you should be speaking to your advisors around that or other professionals to help you with the financial statement reporting. At this point, we are hopeful that some guidance will come out of the AICPA and FASB, but we're not certain as to when that might happen. All right, Andrew, let's get to some questions. I know we have a number of things that have come in.
Sure, David, did you want to take the first one? If I want to ask my accountant to look into this, where should I direct them?
Well, the employee retention tax credit is driven by the Department of Treasury and the Internal Revenue Service. So you can actually go into the Internal Revenue Service website. They have a tremendous area on employee retention tax credit. I'll do a little plug if you want to go to the GRASSI website. We have a coronavirus resources page, which has a ton of information on Ertc, as well as many CPA firms have
This
resource pages.
webinar wouldn't be a bad place to start either.
Excellent, but that's where your professionals should be looking forward to in terms of getting more information.
There's a couple of quick ones here that I think we can answer very quickly. Do in-kind contributions count as gross receipts, such as legal or accounting? No.
I would say no, because the Treasury regs are geared towards how you report gross receipts on your 990 form, your IRS form 990. And we know donated in-kind services in the 990 are excluded. Therefore, we would surmise that in-kind would be omitted from the gross receipts calculation.
And then there's just a one that just is a quick clarification. When looking at eligibility for 2021, is a look back to the same quarter in 2019 or 2020 for the revenue reduction. So it would always be back to 2019. So in 2020, you're looking back to the same quarter in 2019. In 2021, you're using that quarter in 2021, and you're looking back to 2019 for the comparison. So
19 is always the baseline because that was pre-pandemic. So everything is right. 20 or 21 in any of these programs is always baselined back to 2019. For the most part, always going back to the 2019 baseline period.
And then another quick, easy one to do is this only applicable to federal, or is, they're asking, does it apply to state and local taxes? And no, this is only applicable to federal employer taxes.
And that's why the 941 is used for the purposes of reporting the tax rate, because it only focuses on the employer portion of the Social Security taxes that are paid based on eligible wages. So it is a federal Social Security tax credit that is obviously more than what you would have put in on any particular quarter, I would imagine, which is why the the tax credit and potential refund of cash comes into play.
So I think some of the other questions here get a little bit more into the government shutdown piece of it. But one easy one, David, I think would be if they are using for example, the full or partial shutdown option, does the look back provision apply to eligibility? So if they qualified, say, in second quarter of 2021, and they technically, I think the answer would be yes, right? They do qualify for quarter three because of look back provision.
Our opinion, our thought here is the look back provision for qualification. If you don't qualify in the current quarter, when you look back, regardless of which criteria you qualified under, meaning the partial shutdown or the gross receipts test, you did qualify. And if you qualified, you would then automatically qualify for the subsequent quarter because of the look back rule. I don't believe the provision of what qualification has any impact on the look back provision going forward.
And then I think the one issue here, we don't want people to get confused. There is a question here about we were limited in attendance by the government mandate until May 15th or so. The issue here isn't about attendance, it's about gross receipts, it's about your income itself in terms of making the calculation. So limited attendance is one component, but as we talked about earlier, you really do have to, if you're not looking at the gross receipts reduction of 20% compared to, say, quarter one of 2021 to quarter one of 2019, and you're deciding to pursue the full or partial shutdown because of a COVID-19 governmental order, it's not because you can't say, our attendance was limited. It has to translate into the actual impact on your business operations from a gross receipt standpoint. Correct,
right,
David?
So I would clarify that a little bit differently, Andrew. I would say that if your attendance is limited by government mandate, that means you're following some type of New York State executive order, which is following a federal order out of CDC or HHS. So that ties you into the governmental mandate piece of it. The limited attendance, more than likely, is probably because of social distancing, which is one of the executive orders in New York State as well. And to Andrew's point, if you have multi programs within your arts organization, you need to make sure that the revenue driven by attendance is not insignificant, or at least it has to at least be 10% of your overall total revenue for the quarter. And I would say looking at 21 and looking at 19. It doesn't mean that you have to have a 10% loss around it, but the revenue generation by that attendance has to be at least 10% of your overall organizational revenue. If attendance is your only source of revenue coming into your arts organization, then if you have a drop of attendance because of social distancing and that's your only operation, only program, I would say you more than likely will have yourself an eligible position to take for that particular quarter. And again, if that position will move forward in a look back period going forward if you don't qualify the next quarter.
Great, thanks for clarifying that, David. I think another question here that can be quickly answered is related to grocery receipts. They're just asking, their earned income decreased, but they still received a random increase in donations, contributed income. Do they have to include that in gross receipts? And yes, that would be the answer, right? That
100% correct. 100% correct. Do not, folks, use the shuttered venue definition, right, in looking at ERTC, because some of the terminology that person just asked is SVOG terminology, and it's a different terminology. Earned, not earned. It's all revenue under 6033, which are the 5 buckets we talked about earlier, which includes contributions, fee for service, attendance, and everything else.
And then there's a question about full-time employees. Do we count employees who work less than 30 hours per week? From a wage perspective, when you're claiming the ERTC, yes, you can absolutely claim all qualified wages. When it comes to what we were talking about earlier with that 30-hour kind of threshold is just in calculating, are you at, it really is not going to be an issue for most employers. If you don't have 500 employees or more, you really are not going to be looking at that 30-hour calculation. So if you have less than 500 employees, you qualify. If you have part-time employees and full-time employees, you can look at using those wages to in their applicability to the employee retention tax credit.
All right, I think, Andrew, I think we have just one last question about the unions. If you want to, if you see that one, I'm not sure I can answer that one. Now that all restrictions have been lifted, but the unions still have limitations, are we still closed? That's a tough one. Here's my answer to that one. Ask legal counsel. That is more of a legal question than it is a question for the accounting side or the calculation side. Just because the union has limitations, are those limitations focused by government mandate and order, which then impacts your operation? Or if your operation itself is not mandated by a reduction, by partial or full shutdowns by mandated government order, I'm not sure whatever the union has in place has any impact on your organizational mandate.
Right, that might be more contractual. So I would think, David, that would be, since New York has pretty much eased all government. It might be tough. I think it might be. It definitely would be a legal counsel question. But my guess is that's going to be probably a tough one to substantiate with documentation if there are no governmental shutdown orders in place right now.
Agreed. Abigail, the floor is yours. We have hit 60 minutes.
Yeah, so thank you both so much, Andrew and David, for today's presentation and getting us through it and answering all the questions. And thank you to everyone who joined us and had questions. It's been such a valuable conversation supporting the continued navigation of our sector, the arts sector, through these key stimulus programs. This webinar, as we said, has been recorded. We'll be posting to the NYSCA Presents website page, and we'll also email you the link so you'll know it's up and available. I think it's coming up on the screen, but another reminder that our first funding opportunity, Restart New York, Rapid Live Performance Grants, closes tomorrow. And all of our grant information can be found on our website. Links are there on the screen. The NYSCA staff, help desk are available to assist you in any way. Mark your calendars. We're having FY 2022 webinar week on July 12th through 16th. So you'll have virtual events, you'll be able to join NYSCA staff from all around the state for informational webinars and working virtual office hour sessions. So each virtual event will be recorded and posted to the NYSCA website, and there'll be information regarding registration forthcoming. So thank you again. The NYSCA team is grateful that you came and proud of your creativity and resiliency over this past many months. And as always, we're honored to be with you as we rebuild New York together. And thank you all. And thank you, Andrew and David.
Thank you.
Pleasure. Have a great day. Have a great weekend. Enjoy the holiday weekend, everyone.
Absolutely. Bye.